Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is investing in dividend stocks. And over the course of the last few weeks, as we've been launching this series, we've talked about the dividend aristocrats, we've talked about the dividend kings, we've also even talked about something known as the dividend monarchs. Well, today we're going to scale that back a little bit. We're going to look outside of those arenas for dividend candidates into what I call the dividend working class. I think this is going to be an interesting discussion. Does it have to be an aristocrat or a king to be a qualified potential investment candidate? Or could there be some companies out there maybe haven't been increasing dividends yet for 25 years? Maybe they cut dividends once some years ago. We're going to be exploring that concept, setting up an example scan to look for those kinds of companies. But before we can do that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names out there on YouTube, as there always are. Hello there, Janelle and Sharon, Dinesh, Josh, Paul, David, Mighty Mouse, Eric, Simone, Eva, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But be aware that you're invited to join us in the live discussion if you'd like to be here. This is a Thursday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let everyone in the live stream audience know that my very good friend Brent Moores is going to be hanging out in the chats with you. Brent's going to be keeping an eye on any questions that come in. And if I can't get to those as I'm presenting, then Brent's going to be there to pick up my slack. Thanks for having my back there, Brent. Brent and I have now been working together for more than 20 years. We're working on our 21st year as peers here in this effort. So Brent brings a ton of experience to this discussion as well. So great to have him here. Brent and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. You can find us on X. You can follow Brent there on X at Brent Moores CS. You can also find and follow me on X at Cameron May CS. Now, as of just a couple of months ago, we've started introducing coaches to LinkedIn. So you can find me on LinkedIn if you go to linkedin.com/in and then just /Cameron May CS. But let's get into this discussion. The dividend working class. This might be a new concept to some of you, although I kind of slid it in a quick introduction a few weeks ago. But of course, dividend investing, like other approaches to investing and trading, carries risks. So we need to be aware of the risks. Let's bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as the sole means of investment research. Investing involves risks, including loss of principal. Risks of REITs are similar to those associated with direct ownership of real estate, and any investment decision you make in your self-directed account is solely your responsibility. All right. So with all of that, let's set an agenda for today's discussion. So first thing that I want to do is take a quick peek at the markets and look at the sort of conditions that exist out there for dividend investors. I know for stock investors, over the last couple of days, it's been a little bit rough, but for the longer term, maybe our long-term dividend investor doesn't really care. But there is something interesting that's been happening, and particularly accelerating since the turn of the year. 2026 has been a really strong year for dividend investors, so I want to talk about that. Then we want to take a quick look at our example portfolio that we've been building, just to look to see how that's coming along, look what its needs might be, and how a new position might be selected to be complementary to that portfolio. And finally, then we're going to go look for that new stock investment. Obviously, dividends are going to be a priority, but we're not going to be looking at dividend aristocrats or kings or monarchs. We're going to filter those out, see if there might be some candidates outside of those arenas. So we're going to be looking at the dividend working class. That's my title for it. Building a scan for companies outside of those other three groups, and then making an example investment in one. So let's go have a look at what's going on with market conditions for our would-be dividend investor. So let's first of all, this is what I do each time we discuss things. We look at what's going on with the competition. Let's put that in air quotes. What we're talking about is competing for the income investor's cash. And maybe an income investor might be deciding between, well, do I buy stocks that are paying dividends or maybe invest in fixed income? Here's what's been going on with fixed income just recently. Looking at long-term, these are 10-year bond yields. Chart symbol is TNX:CGI if you want to follow along. But yields have been hanging right around. They've been kind of fluctuating around that 4.2% level. So when you see a 42, we just move the decimal one position to the left, 4.2% on 10-year yields. You can see that for a while there, we were above 4.2%. For several months, we were below 4.2%. And we started to creep back up above, but just recently retreated. What's been going on? Why have yields dropped? And particularly, why did they drop today? Well, looks like the new claims for unemployment a little bit stronger, jobless claims a little bit higher than anticipated. So if the job situation is weakening for some that are looking down the road on the impact of maybe Fed rate decisions, there could be some that are a little bit more concerned, if concern is the right word for it, but maybe they're looking for a higher probability of a cut to the rate. Well, that may reduce yields. They might think, well, that hasn't happened yet. That's only speculation, but investors, being the sorts of creatures they are, instead of just trading on today's information or investing on today's information, they may be looking down the road and making portfolio adjustments right now, and that can also impact. That can also be reflected in changes to yields, even for events that haven't yet transpired, even that remain in the realm of speculation. So that might be what's happening here. An increased expectation of potential additional cuts to the Fed funds rate, that might explain what's going on there. Now, obviously, there can be independent demands, well, at least in supply and demand in fixed income, that could be influencing this reduction in the net yield. But that's where we find ourselves right now. So if yields are coming down for our income investors, the fixed income may become comparatively, by a small percentage, less attractive than maybe equities. So let's go see what's going on with dividend equities. And there's an index that we use in this discussion. I'm going to come right up here. Let's go to our recent charts, and I'm going to have a look at the S&P Dividend Monarchs Index. So if you're not familiar with this index is a total return index of the dividend monarchs, companies that have been increasing dividends for 50 years or longer. Not in the case of dividend monarchs, they are required to be part of the S&P 1500 rather than the S&P 500, but paying increasing dividends for each year for at least 50 years. And the assumption here on this chart is that dividends are reinvested, and the chart reflects growth in share value plus those reinvested dividends. So it's a total returns chart. And look at what's been going on with these dividend monarchs, plus, with reinvested dividends since the turn of the year. Since 2026, we've seen an acceleration, running up, a little bit of a consolidation here, but running even higher. Now, contrast that with maybe what we've been seeing on like the NASDAQ or even the S&P, kind of struggling to advance to highs. So dividend stocks, comparatively, are doing really well, especially over the last, well, at least over just the start of the year. And really, this does stretch back to November. What might account for that? I can never speak for the market as an absolute, but could this be a reflection of a retreat to safety? Maybe investors are turning their attention away from speculative positions like technology stocks and more toward the longer term growth and income scenarios. That's a possibility. Now, another thing that might be contributing to this is, I don't know if anybody caught the Palantir CEO's comments about software as a service, companies that might be impacted by AI. AI has been driving a lot of growth in a lot of tech companies. Well, a lot of tech companies are selling off in recent days, and some of that seems to be related to Palantir CEO saying their company and a lot of others may be using AI to streamline software as services. It may actually impact negatively the performance of software as a service types of companies. In any case, we are starting to see some technology selling. Doesn't mean that it's going to continue, but maybe if AI and those kinds of companies have been attracting a lot of speculative cash, maybe that's starting to rotate toward more defensive, more income-oriented sectors. That could be at least a partial explanation for what we're seeing. But in any case, it seems to be a pretty favorable, from the start of January to the present day, pretty favorable condition for dividend investors. And that's actually been reflected in our example portfolio. We've only been building this for a few weeks, 4 weeks total. We have 4 companies that we purchased, and they're actually doing quite well, up on average 4.5%, ranging from about 2.9% on the low end to about 8.7%. And we weren't in this as a trade. These are example investments with a long-term outlook. But let's just have a look at these. Let's do a quick portfolio review. We're managing an example $200,000 portfolio, putting about 5% into each position. So that's been the sizing approach taken to these positions. We've been distributing those across a range of sectors. Now you'll notice we have utilities, we have staples, we have energy. Those 3 of our 4 are actually in what we might call the defensive sector or sectors. So if there's that concern about the speculative positions and more technology heavy positions starting to struggle, and if there's that rotation toward a defensive posturing in portfolios, then this example portfolio seems to be relatively well positioned, at least for now. We're going to be adding to this. We're going to be spreading that out, but seems to be well positioned for those kinds of market conditions. And so far, yeah, it seems to be working. Anyway, that can change. Nothing's a guarantee, but we are going to be moving. Let's further diversify our portfolio as a priority for today's position. So far, real estate, energy, staples, and utilities. Let's see if we can go outside of that. We also track, for the purposes of those that maybe like to ladder the payments of their dividends, we're keeping an eye on the ex-dividend date. Now, actually, you'll notice that 3, these are, again, the sector can have an influence. Most sectors, companies from different sectors will tend to announce, or from the same sector will tend to announce their earnings about the same time. They tend to pay the dividends about the same time. Anyway, but for some investors, it can be, to some extent, important to stagger those dividend payments as much as possible, maybe to get a more consistent income throughout a year. And right now, we're kind of concentrated in February. We'll see if that plays a role in our decision making today. We can see that we do have one company that pays monthly dividends, and the other 3 are paying quarterly dividends. Our average yield is about 3.5 times an average dividend paying company from the S&P 500 right now, that being about 1.1%, whereas our portfolio is more like 4.1%. Beta is actually on the lower end. This is our measure of volatility. 3 of our 4 positions have lower than average volatility. Dividend payout ratios and long-term debt, we've been keeping an eye on. We have our trade price and our mark. Now, again, these are not trades so much as investments in this example portfolio, but one thing that we will be keeping an eye on is our profit or loss, because we were very deliberate in the position sizing of each of these investments that we made. And for our example portfolio manager here, as long as the dividend continues to be paid and is not cut, maybe what they prefer to do is keep the sizing roughly proportionate. So if we have one company that really blasts off, and that happens from time to time, it can grow to have a disproportionately large influence on the portfolio. Maybe they want to scale that one back. Now, at the same time, if we have a company that's continuing to pay those dividends, but it hits a rough patch in its share price and it drops, and now it's a relatively minor player in that portfolio, maybe at that point they might add to that position. So what we'll specifically do for this portfolio is that and right now these numbers are not terribly large, a few percentage points up at the moment. But KMI, as an example, is already up almost 9% since we bought it just a few weeks ago. We're going to let that continue to go. Still, that would make it only maybe 5.1% of the portfolio, something like that. But if we see this profit or loss either grow by at least 60% or drop by at least 20%, at that point, that's going to be our threshold for reducing a position or adding to it. So none of those are threatening to do that right now. So overall, there's our portfolio. Oleg says, I'm trying to catch up. The first time in this session, is it possible to see the portfolio? So this is the portfolio. If you want to see the logic, though, Oleg, of these investments, you can go back and watch the previous webcast. So let me make a quick suggestion for anybody that is a first-timer here. First of all, if you haven't subscribed to our YouTube channel, it's called Trader Talks Schwab Coaching Webcast. Do that right now, because this is where you can go join the live streams like we're having at this moment, or you can find the playlists of previously delivered webcasts. So if I go to playlists here, just right there toward the top, there's our Investing in Dividend Stocks playlist. And if you click on View Full Playlist, this is a series we just launched in 2026. So we're only just starting February right now. So there have only been 4 webcasts already, and you can find those previous webcasts right there. All right, Dean says, first time in this session. Welcome, Dean. I know I've seen you before, so I know that you're familiar with all of this. But yeah, great to have you in this series. But that's where our portfolio stands. That's sort of the market backdrop for what's going on with a dividend investor. So now let's talk about the example priorities that we have for this portfolio. Then we're going to do a scan. We're not going to lean though into, let's say, the aristocrats or the dividend kings, and instead we're going to construct a scan for stocks that may suit the priorities of our portfolio. It may not exactly be yet an aristocrat or a king, right? So what are our priorities in our portfolio? We have a few. This is an example list of priorities. It's not intended to be exhaustive. It's not intended to be the way that every dividend investor should approach their portfolio. But of course, dividends being the focus of this discussion, yield is important. Also, we have been placing ourselves in the shoes of an investor who's trying to accomplish some degree of risk mitigation through diversification of the portfolio. So diversification is playing a role in the selection of our stocks. The scheduling of dividends might play a role. Right now, we have a number of dividends that pay in February. There's one that pays in January, but it also pays in February. That one pays actually every month. And for some, they like to ladder their dividend payments. So they might buy companies, for example, that pay in February, and each 3 months from there, maybe they buy a company that pays in March, and each 3 months on a rotation from there, just complementary dividend payment schedules. So that could be a priority here. But consistency, typically a big deal for a dividend investor. It's nice if a company just started paying dividends, but if it has no track record of paying dividends, maybe it continues paying dividends, maybe it doesn't. But consistency has been a point of emphasis in this discussion. That consistency can come under threat if there's a lot of debt with the company, so we keep an eye on debt. Also, for some dividend investors, they like their companies to not be terribly volatile. Stocks that really swing up and down as we're waiting for one quarterly or one monthly dividend to the next can give some investors heartburn. So volatility can be a point of emphasis. And finally, just net performance. What do I mean by that? Well, total performance is, yes, collecting a dividend, but also if our stock is losing more money on its share value than it's paying in dividends, well, that's not even delivering a net positive result for our would-be investor. So instead, maybe they look at something over the long term where price appreciation plus dividends is at least performing a left to right advance on a chart. There we go. So there are our example portfolio priorities. Let's go look for companies that at least historically have done a pretty good job of delivering on those priorities. Maybe that means they can continue to deliver that in the future. Obviously, nobody knows the future. But in the past, we've talked about companies with long-term track records of increasing their dividends. So, for example, we have the dividend aristocrats, which are S&P 500 companies that have paid dividends or have increased dividends at least once or well, at least every year on an annual basis for the last 25 years. Now, there's also a group of dividend paying companies known as the dividend kings, where they've been increasing dividends for at least the last 50 years. Now, those are both a pretty high bar. Is it possible that there may be, let's say, quote unquote, quality dividend companies that maybe haven't reached the 25-year threshold? Maybe they haven't reached that 50-year threshold, or maybe there was a time when they even cut dividends, but they've recovered. Maybe price is up. Maybe they've been increasing dividends since then. So I'm going to be extending the type of company that we look for into what we call the dividend working class. Maybe they're working their way up through the ranks. Maybe I should call them the dividend American dream. I don't know. But let's keep these priorities in mind as we start to build a scan. So let's go to our scan. As a matter of fact, if you were here a few weeks ago, I built a scan and saved it, and it's called the dividend working class. But I didn't focus that discussion on the dividend working class. So I wanted to revisit that concept. So since we've already built the scan, I'm going to kind of cheat, and I'm just going to go up here, and I'm going to load the scan. So here's my personal scans. We go to load scan query, personal, and there's our dividend working class. And I'll revisit the logic of this. I'll explain how this was built. But I also think it's fair that if you're just joining, you didn't get to see that, let me share this scan with you. So let me just quickly do this. Here's my dividend working class scan. Okay, there we go. So I just pasted a link to this scan in the chat window for the live attendees. I'll also put it in the video description after I've concluded the webcast, so that those that are watching on the recording can find that scan. Now this scan, if you'll notice, the very first thing it does, it's called the dividend working class scan, but it excludes the dividend aristocrats, which is a personal watch list that I've created. So if we don't also have that watch list in our paper money, the scan doesn't work. So let me also share that watch list. How about we come over here? Let's go to our watch list. Let's load up personal dividend aristocrats watch list, and let's share that. There we go. So I'm going to post that in the chat as well. And when I share a link, the way to open that link, is to just come up here, up in the upper right, there's a little gear icon, and we can just choose open shared items. So you just copy the link that I've shared, pop it in here, click on preview, click import, and for a scan, well, that'll now be found in your, let me just cancel this, but we'll be able to find this by going to the load scan query. It will then show up in your personal menu just like mine did. Or for a watch list, it will now show up in your personal watch lists, just like mine did. All right, so that's how we load those. And so that gets us prepared for this discussion of what I call the dividend working class. So very key to this scan is that we're still scanning in the S&P 500. These are big companies. But we're going to exclude the dividend aristocrats. So just to revisit the idea of a dividend aristocrat, this is an S&P 500 company that has paid dividends or increased its dividend annually every year for the last 25 years. So it kind of begs the question, is it possible that maybe there are some companies out there that have been increasing dividends, but just not for 25 years? Or maybe they did cut the dividend once, but maybe as of today, they might still be qualified, maybe not quite the track record of consistency of the others, but they might meet our other criteria for investment. Yeah. So here's how the rest of our scan is built. We're going to exclude the dividend aristocrats, which by default is going to exclude almost every single dividend king as well, since almost all the kings are also in the dividend aristocrats. So let me see if I'm missing any questions. Bob says in the public watch list and Thinkorswim is 25 plus years. Shouldn't that be aristocrats? Bob, I'd have to look. I'm not. I know most of the public watch list, but not every single one. So I'd have to just double check. So I don't want to give a definitive answer, yes or no, because I'm not sure. But in any case, for this one, let's align our filter criteria with our stated priorities. All right. First of all, yield. All right, if yield's a priority, as I mentioned earlier, the average S&P 500 dividend-paying company is paying around I believe it's 1.15, 1.13. It's going to fluctuate as prices fluctuate. So we'll call it around 1.1, maybe slightly higher with the downtick in price, maybe slight uptick in yield, but average is maybe just slightly over 1%. So let's say that our investor is looking for stronger yields than that. Maybe 2%. Now, on the high end here, I've actually put an upper limit to this, 6% yield. Why? Why would I set a 6% cap? Isn't just higher yield better? If we're trying to get dividend payments, why don't we just want to get the really big dividend payments? Well, for some investors who are trying to be in this for the long haul, a very high dividend yield can be a potential red flag. First of all, it's hard to keep that up. When the yield is very large, a company has to generate a lot of profits or take on a lot of debt to continue to pay that dividend. Plus, that yield might also be a little bit out of whack because it might be a function of the fact that price has fallen while the company's keeping the dividend payment constant. If the stock price is falling with a constant dividend, that drives up the yield. Now, maybe a company can hold on to that for a little while, but it does get harder and harder to continue. And what we'll sometimes see is following the stock price, there's a reason typically that stock prices are falling, and it could be because performance is struggling. And if performance is struggling, it's harder to keep up with yields. And anyway, I think you get the point. So if we see a very high yield, many multiples of average, that might be seen as a red flag. So we're going to put a cap here at 6%. Now, next up is the market capitalization of the company. There are small companies out there that pay dividends, but their performance on average tends to be a little bit more volatile, and it can be more difficult for them to achieve a good degree of consistency over the long term. Or maybe they just haven't been around very long. Maybe they're a small but growing company. That can come with some inherent volatility, potential risk to the dividend. So let's just say that our market capitalization requirement is $10,000 million. In other words, $10 billion market capitalization. That's sort of the cutoff for large cap stocks. Probably heard that term before: small cap, mid cap, large cap. Small cap tends to be $2 billion or under. $2 to $10 billion is mid cap. over $10 billion, large cap companies. So we're going to restrict our example scan criteria here to $10 billion companies paying at least a 2% dividend up to a 6% dividend. Next up is volatility. You noticed in our portfolio, our beta values were typically at or below 1. That's the investments that we've made so far. Beta is a measure of historical volatility, benchmarked against the S&P 500. And so if our company has a beta score of 1, that's seen as sort of a stock that tends to move about with the S&P 500. They have kind of a 1-to-1 price movement relationship. If we have a beta score less than 1, those are companies that are moving in the same direction of the S&P 500, but they're not as volatile. If we have a score above 1, those are companies that are a little bit more volatile than the S&P 500. If we had a beta score of, let's say, 2, that would be a company that's twice as volatile as the S&P, at least it has been on average over the last 5 years. So let's set our beta requirement, our volatility measure, between 0.5 and 1.5. So we have large capitalization companies that are sort of around average, a little bit above, maybe a little bit below average in volatility, that are paying higher than average dividends. Now, finally, we're going to put in a requirement for debt. And debt is seen by some investors as a threat to the ongoing payment of dividends. So we've entered here a requirement for what's called long-term debt to capital. Now, these first 3, if you're loading these up, they're just found in the default list. So you can find yield in the default list, you can find market cap in the default list, and beta. So if you're trying to just build this from scratch, you can just use the stock filters that are default when we first bring up the screen or the scan and plug those in. But long-term debt to capital is actually found up here by adding a fundamental filter. So for example, if I'm just adding it fresh here, I could add a filter, fundamental, and then we'll go down to long-term debt to capital. But this is just literally long-term debt to the capitalization of the company, and a heavier debt load relative to capitalization can be seen as a potential risk. Now, there's certainly some fluctuation from one sector to the next for what's normal for the amount of debt, but let's just say that our investor doesn't want the debt load to exceed 50% of that of capitalization. All right. So that's going to be our example scan. Now, notice it doesn't meet every single one of the criteria. So for example, we haven't filtered explicitly for net total performance, but we are going to look at that. We also are going to take a closer look at consistency. We'll also see scheduling through a different process here. But let's run a quick scan and let's see how many companies. How many do you suspect of the S&P 500 companies are paying between 2 and 6%? They're at least $10 billion companies with sort of average-ish volatility, with lower end debt loads. Not truly low end. You can actually see maybe, probably about half. Dagan says, could you please share the study? I've shared both the scan and my watch list of dividend aristocrats. If you need to see that again, you can go to the archive after today's webcast, and I'll have those links down below. In any case, let's run a scan, and it looks like there are 47 companies. So less than 10% of the S&P 500 companies meet these criteria. But also remember, we also excluded the dividend aristocrats. So here's what I want to do from here. Let's add one of these to our portfolio. Now we already have a, do we have healthcare? Wait a second. Let me have a look here. No, we don't have a healthcare. Oh, Viatris, I took a look at this last time. This is a company that's actually struggled historically. Price has just not done well. But how about we look at Prudential in financials? And how about we compare that to International Paper in materials? We already have a real estate company. So let's do financials versus materials. And what I'd like you to do is to help me make a selection here between these two. Now, I've sorted the search results here. When we get the results, we can click on column headings to organize these companies in different ways. So I've actually sorted these according to the highest yield first. Let's just say that's our investors' primary priority, but they still want to keep these other priorities in mind. Let's go have a look at Prudential on a chart over the longer term. And this is not to do technical analysis, support and resistance, that sort of short-term trading stuff. But instead, I'm going to look at this over the longer term. Let's switch this to a 10-year chart. We can see all the dividends that have been paid over that 10-year stretch. But one other customization I'm going to make to this chart is we're going to click on the chart settings. We're going to go to equities, and we're going to adjust for all dividends. Here's what this means. This is saying, hey, chart, I don't want to just see what price has done, but I want to add in all the dividends that have been paid over the time frame that I'm looking at. So it's going to add in 10 years worth of dividends and give us a total return, much like the index that we looked at the launch of this webcast. And so keep your eye on this. You'll notice here's Prudential. This is just a price chart. But if we add in the dividends, there's going to be a steeper rate of change over 10 years. Let's click apply and click OK. Yep. So we can see our total return on Prudential, price plus dividends. 10 years ago, we were here, and here's where we are today. So Prudential basically is up a factor of 500%, or 5 times is a more accurate way to say that. Up 400%, or 5 times. Anyway, so that's Prudential. Another thing that the would-be investor can do while they're looking at this is, as long as we are displaying, let me make sure that on our equities, we're also showing corporate actions. That's what these are: dividend payments, earnings announcements, those kinds of things. We can see an icon for those. It allows a quick spot check. And I think you're going to see something very different between Prudential and IP, International Paper here. But as I point at the little green icon, I can see, all right, the dividend was 70 cents about 10 years ago. Let's go to 8 years ago, 90 cents. Let's go to 6 years ago, about $1.10. We'll go to just a few years ago, $1.20. What's the pattern? Now we're at $1.30, and most recently, $1.40. What's been the pattern? Prudential's been increasing dividends. That could be important for our would-be dividend investor, because if they purchase now, and if Prudential keeps up that pattern, maybe they've set the price that they paid for the stock, and as dividends are increased in the future, the yield on investment increases potentially even more. All right, what was the max number I used for debt to capital? 50. 50 was my number there. Okay, but let's compare that to IP, International Paper. Something big happened here. Let's look at left to right. Company, this one hasn't produced quite the long-term total return. Doesn't mean that's going to be the case. Maybe International Paper outstrips Prudential over the next 10 years. We don't know that. But something did happen if we look at dividends. 44 cents, 47 cents. Let's see what it was here. 50 cents. Everything looks like it's coming along swimmingly. 51 cents, increasing dividends. But right here, as price is falling, not terribly surprisingly, we got a cut. Let's look right here. 51-cent dividend this quarter. What happened the next quarter? 46-cent dividend. There was a 10% cut to the dividend right there. Doesn't look like it was well received in the near term by investors, and the selling off continued. But that's not uncommon. When prices start to come down, yields start to go up, and again, prices might be coming down for a very good reason. Maybe the company was struggling at the moment, had to cut its dividend in any case. or it felt that it had to, so it cut its dividend. Now, since then, dividend has, I believe, let's have a look, 46 cents, 46 cents. It's been stable, not increasing, staying at 46. What do we think? Dividend investors, Prudential, or International Paper? Both of those achieving net positive total return over a long time frame. Both these are dividend paying companies paying above average yields. Both are contributing to the diversification of the portfolio in different sectors. Which one should we choose? I think we already got some votes here. As I look over here to the chats, I saw Cecil saying Prudential. Eva saying IP didn't make the cut for me. Simone, Prudential. Sharon, Prudential. All right, let's add Prudential to our portfolio. So I'm just going to go place the trade. Let's change this to Prudential. This is a one. Oh, this makes my math really simple. It's basically $100 company, right on the nose. We invest about $10,000 into each company. That's 5% of our 200,000 example portfolio. So let's just click on the ask price. So 10 shares would be $1,000. 100 shares would be $10,000. Let's just go ahead with 100 shares at $100-ish per share. Obviously, it's going to be a little bit more than 10,000 bucks. But I'm going to place this as a market order. Obviously, there are risks when placing market orders. We might not be thrilled with the price that we receive. The advantage is we might be in position to make a quicker trade or a quicker investment. Someone, I always, I read my comments on YouTube, and somebody made an objection to this and said, hey, limit orders are the way to go. Some people can certainly feel that way. But I think they had the impression that that somehow we make more money, meaning Schwab makes more money, whether we use a limit order or a market order, that somehow the difference between the two goes to Schwab. There's not a commission on these trades. So there can be on some types of trades, but I just want to make it clear that the purchase is not being made from Schwab. When we're buying stocks, we're not buying stocks from the company. So if we're able to buy at a lower price, that's great for the investor. But if we pay a higher price, it doesn't necessarily mean that the broker made more money. I thought there was maybe a little bit of confusion there, maybe an opportunity for me to clarify that. Okay, so yeah, it's up to the investor whether they use a market order or a limit order. But my statement earlier was, if we're investing for the long term, whether we buy at $100.25 or $100.20, is it really going to make a big difference in the performance of the long-term performance of the portfolio? Probably not. In any case, let's send this order off. Not a commission on this, but should fill pretty quickly. Market order just filled, yeah, $100.26. So now we own some Prudential, and we'll see how that goes. Look at that kind of little slippage right as we got into that position, but we'll keep an eye on that in future webcasts. But guys, we've accomplished what I set out to do today. I wanted to talk through current market conditions for dividend investors. So I wanted to look and see how the portfolio is performing and what its needs might be through the lens of that through that hypothetical dividend investor. And then we talked through what I call the dividend working class. They're not the elite, maybe, but could they be on their way? Time will tell. We'll see. But in any case, I hope you had some fun with that one. This is what we do with these Thursday webcasts. You're certainly invited to join me each Thursday if you'd like to be here. We'll continue to build out this example portfolio. We'll have additional discussions about the pros and the cons of dividend investing and how it might be accomplished. But I'm going to let you go. Eva says, can we do this every day? Well, we can do it at least every week. But as I let you go, just remember that you have some great resources available to you from Schwab Education. Starting with, if you haven't subscribed to our YouTube channel yet, do that now. The YouTube channel is Trader Talks Schwab Coaching Webcasts. And this is where you can join our live streams. You can find our playlist of previous webcasts, and you subscribe just by popping down below the video. Click on the subscribe button right now. It doesn't cost anything. It only takes a second. Another suggestion that Brett and I definitely have for you is to follow us on social media. You can find Brent and me on X. You can find Brent on X at Brent Moore CS. You can find me there at Cameron May CS. We're both very active. And if you reply to one of my posts, I try to reply right back to you. It allows for interaction when the camera's not on. Now, you can also, as of a couple of months ago, follow me on LinkedIn. So you just go to linkedin.com/in and then go /Cameron May CS. That'll take you to my profile. You can give me a follow there. But I post regularly here. So for example, I just posted this video today about creating groups on Thinkorswim to organize our positions however the investor sees fit. So just a little 2-minute video that I put on there. But if you reply to my posts here, I try to reply right back to you as well. All right. Everybody, thanks for giving me your time today. Thanks for all the thumbs up. That's always appreciated. That's like a pat on the back to your presenter. I can see 162 people watching right now. 59 have already clicked the thumbs up or like button. It's like applause to your presenter, but it also gives a boost to my videos in the YouTube algorithm, helps more people find these discussions, learn things like, what is this new thing Cameron's talking about, the dividend working class? Just a sort of funny name that I give to it. But anyway, everybody, I will see you in a future webcast. I'll also look for you on social media, on X or on LinkedIn. But whenever that time arrives, until then, I want to wish you the very best of luck. Happy investing. Bye-bye.